Hello friends, this is Professor Amarjeet Kaur, Professor of Accounting and Business Communication at the Department of Management, Gurugram University, Gurugram. This is my privilege that I am here with you to talk about innovative debt instruments. This is the fifth session of the same series we are running from the last couple of weeks. So, I shall be talking about today about two main innovative or non-traditional debt instrument. One is NCDs with warrant, and second would be payables when able structures, PWA. So, friends, I hope you all understand that any business would require funds to run its operations, right? And those fund requirements could be for short term, could be for long term. And a company may fulfill this requirement by either using debt instruments, debts or loans, or through equity, the owner's fund. And not only that, a company may use internal funds as well, because these two, equity and debt, are external ones. Internal ones like depreciation which has been accumulated, or any reserves which have been accumulated, like that. So, company may use internal sources or external sources. In the external sources, as I said, we have two options, debt option and equity option. And within the debt option, we have traditional debts, the the conventional ones, or we have the non-conventional ones which we call as innovative debt instrument. In the innovative debt instruments, which means I am talking about the leverage, the composition of debt and composition of equity. In the innovative debt instruments, we have already talked about many instruments in the past. We have talked about zero interest bonds, we have discussed about deep discount bonds, DDBs, we have talked about secured premium notes, floating rate bonds. We have also discussed the callable or puttable debentures or bonds. We have talked about market linked debentures in the past. In case you want to see these and or you want to understand any of these instruments, you can refer to the previous series about this. We have also talked about green bonds as well, which are very latest innovation, very latest addition to the innovative debt instrument, because the green bonds have started after the green moment, after the green finance has emerged as one of the options, right. So after discussing these 7 debt instruments in the past, today I am going to talk about NCDs with warrants and payables when able, PWA structures. Now the question comes in, what NCDs with warrants are? So, NCD with warrants, we call them, NCD means non-convertible debentures, NCD. So, non-convertible debentures refer to debt instrument that come with a warrant which gives the holder the right to buy shares at a specific price later. In 2021, SEBI issued guidelines to regulate issuance of NCDs through qualified institutional placement, QIPs, and similar platforms. So, as the name suggests, non-convertible debentures, it means we do have convertible debentures as well. So, non-convertible means they cannot be converted into equity. So, it refers to the instrument which is a debt, of course, because we are talking about only innovative debt instrument. So, it means it is a part of debt, fund is raised through debt. So, that is the primary or premise of the instrument I am talking, and it comes up with a warrant which gives the holder, whosoever is buying those debenture, the right to buy shares at a specific price later, right. So, it means in the beginning they are non-convertible debentures, means they will not be automatically converted after some period, because convertible debentures are the ones where we have certainty that after 5 years, 10 years, 20 years, they would be converted into equity. But here we do not have any compulsion as a buyer to get them converted into equity, rather we have a warrant attached to the debenture which gives a right but not mandates. So, the holder of the debenture has a right to buy share at a specific price later. So, price is known to him and he or she may exercise the right to buy or may not. So, the SEBI is the governing or regulatory body for NCDs. In 2021, they issued a guideline. The SEBI issued a guidelines to regulate how to issue NCDs, non-convertible debentures, through, so they can be issued only through the QIPs. We call them as qualified institutional placements, and there are many such similar platforms. So they can be issued through those platforms where we have assurance of transparency, price to be known, everything. And then further, the SEBI's guidelines, they require the use of an EBP, like electronic book provider platform, for the NCD portion of the issue to guarantee price discovery and transparency. And so, what does it mean? It means the SEBI has mandated, had made it compulsory after it issued the guidelines in 2021, that it is mandatory to use EBP, which is electronic book provider platform, right, EBP platform. So, which means that NCDs cannot be issued on a normal platform without using this platform. Why? Because, and so SEBI wants that price at which the the branches NCDs would be converted into equity, what is the price, and also to ensure transparency. There is no hanky-panky business in between. To ensure these two things, the guarantee price discovery, whatever they have granted, discovery of that, and the transparency. So, it is mandatory to use EBP to issue NCDs. And this NCD with warrant comprises two parts, as the name suggests. One is the component of the debt, that is NCD, the debenture itself, right. So, it comprises the first part, which is debt component, non-convertible debenture, and the second component is the warrant, which is equity component, but that becomes effective only if somebody who is holding the debt, the debentures, the NCD, decides to exercise the right, right. So, the warrant is attached. So, that is how this whole instrument is divided into two parts, debenture, the debt part, and the equity part, right. So, what is warrant? A warrant is a derivative that enables the holder with the right but not obligation to purchase a firm's or company's share at a pre-decided price within a specific time frame. And NCDs with warrant are typically offered through a qualified institutional placement, QIP. It is mandatory, you cannot actually sell without QIPs. So, the warrant is also, no, you must be surprising, like you may not have heard this word warrant before. So, what is warrant? Warrant is a derivative, right, like many more derivatives we have. So, it is a derivative which enables, which gives power, which gives right, which enables the holder, the debenture holder, NCD holder, but there is no obligation. It does not mandates, it does not obligates the holder to purchase firm share at a price which is already decided in advance and within a specific time frame. It's not like that you can buy any time, it's not open. So, the price is decided in advance and the time frame, it is not that on particular date, the time frame, broader time frame is decided in advance. So, that is how the warrant works. So, it means it is a derivative, right. So, how does this NCD with warrant works? So, what happens? A company issues NCDs with attached warrants as a combined product. Investor can decide to subscribe to both NCD and warrant together or separately. So, what does it mean? It means there is a flexibility to companies and also to investors, the prospective debenture holders. So, company will issue NCDs, a debenture, which is a debt part, debt instrument, with an attached warrant, right, as a combined product, as a combined financial instrument. Because product, when I say product means I am referring to financial instrument, right. So now investor has a discretion to choose either to subscribe the NCD and warrant together as a stapled. So we call it as a stapled NCDs or as separately segregated NCDs. So that's the common term which is used in the market, stapled NCD or segregated NCDs, right. In the staple, the warrant is together with NCD. It means you can't differentiate the price of warrant and the price of debenture, whereas in the segregated one, because in segregated one it becomes easy to sell even a warrant, because even that is independently saleable, right. So separately segregated one will have a warrant separate and debenture part separate, means value of both of the investments, because for an investor it is an investment, right. So value of the investment in debenture, which is and the warrant, which is the equity part, and the debenture part is known to the investor in advance. So the company can bundle it either way. Company can design, because we are talking about innovative, and when I say innovative means there is a flexibility of interest, time frame, payments, maturity, etc., etc. That's how they come under innovative debt instrument. Had it been a normal conventional debt instrument, then it is very much clear that we know the coupon rate, the interest at which the interest would be paid, the rate of interest is known in advance, date of interest due is known in advance, the maturity date is known in advance, everything comes on the face. That is for a regular conventional instruments. Here we are talking about innovative instrument. That's how these changes are unique from one to the other. Okay. So further, the NCD portion is processed on the mandatory EBP platform, providing the fair price for determining its price. If investors exercise the warrant, they get share at a pre-notified price, which is treated as a debt for equity swap. If not, NCD is to be repaid by the company to the investor. So it means it's very clear what I actually just read for you. The non-convertible debenture, the portion which is debenture portion, is processed on the mandatory EBP platform. As I said, electronic book platform, we have to use that. So it cannot be processed at any other platform, and that is what and how the company has to put the price, and the investor would know the process exactly, and this use of EBP ensures fairness of the process, ensures transparency as well, right. So it's providing a fair process for determining its price. So because you would know exactly at what price this is being offered, and if no investor, as I said, is not the warrant part is optional, it's not mandated. So if investor exercises the warrant, what does it mean? So they get share at a pre-decided price, and then this is treated as a debt for equity swap. If they decide to exercise the warrant, means they are swapping the debt component for equity. So we call it as right, or we call it as swapped. So the person has swapped, investor has swapped the debt component for equity, right, swapping of debt to equity. So if not, then we say, then what happens? Then the NCD is to be repaid by the company to the investor on the due date, which was decided already in advance on the and is written on the instrument. Okay. So the NCD is to be repaid in the second. Otherwise, if it is that portion of NCD which was warrant, we are not talking about the rest of the debenture part, is anyways going to be repaid by the company, right. I hope you are getting my point. So because we have this instrument has two parts, the debenture, the loan part, I mean the debt part, and the warrant, which is right to convert or right to swap into equity part. So I am talking about the warrant part only if an investor decides not to swap, not to convert the warrant into equity, into ownership, right. In that case, the NCD is to be repaid by the company to the investor. Okay. So we have a couple of examples. In India, what happened? After the global financial crisis of 2008, which we all know, which has happened because of the bubble in the housing sector in states and many more countries. So in 2008, SEBI allowed Indian companies to issue non-convertible debentures with warrants to QIBs. Like, so what are QIBs? The institutional buyers, like mutual funds, like banks, like insurance companies, they all are known as QIBs, right? So they all are institutional buyers. So earlier it was not allowed. In after 2008, it has been allowed now, that the companies which are Indian companies, and they can it is allowed that Indian companies can issue NCDs to the QIBs. So if we have X mutual fund, your Y insurance company or Z bank who are institutional investors, they can actually buy NCDs. This why was it done? It was implemented to help companies to raise funds from institutional investors, because at that time the financial crisis arose, and because of that we were not able to get the foreign currency convertible bonds, which was an alternative. So invest and to, so this helps to, or this provides an alternative to foreign currency convertible bonds, FCCBs. So this is an alternate to that, So foreign currency convertible bonds, which were otherwise, invested by the foreign investors, now to give a kind of support to the companies, SEBI issued a guideline that in 2000, after 2008 crisis, which was a global crisis, of course we all know that companies can now issue NCDs with the warrants to QIBs as well, which was a good initiative, is appreciated. That is why now those assets which are multi-assets funds. We have debt funds, we have equity fund, balance fund, and all that in SIPs, in mutual. So those multi-asset funds, right, would or may have NCDs as well as part of their fund. Fund manager is now, after that crisis, after this decision of SEBI, is allowed to invest in NCDs as well, because the multi-assets would have gold, would have derivatives, would have debts, would have equity, preference, many type of assets. Nowadays people are really betting on silver, which is really shooting like anything, and especially when a few countries were, gold and silvers are really shooting high in the market. Because of the accumulation by states, because of the accumulation by neighboring countries, because of real demand for these two metals. So people may have, the fund manager may have allocated certain part of the fund into these metals as well, yellow and white metal as well, right. So this also becomes one of the option, NCD also becomes one of the options for fund managers to invest in. So we have one good example of NCDs in here. For example, Vodafone Idea and American Tower Corporation, ATC. In 2022, Vodafone Idea, they the board approved the issuing of optionally convertible debenture, OCDs, to ATCs. While not a, so this is not an example of strict NCD with a warrant. This is an example of issuing debentures with an enabled equity option, right. So we may not call it as pure form of NCDs, but this discussion is about innovative debt instruments. So when I say innovative debt instrument means even here we have further flexibility to innovate with the instrument. So the Vodafone Idea, they innovated, they made it as optionally convertible debentures. They were not very strict NCDs, but example of NCD only, that category only. So what are the merits and demerits of NCDs? I am going to discuss that now. So when it comes to merits of NCD, there are a couple of them. The first one is combination of stability and growth. Number 2 is higher returns than regular NCDs. Number 3, leverage opportunity. Number 4 is flexibility. Number 5 is capital appreciation with limited downside. So let me explain them to you now. The first merit of NCD is the combination of stability and growth, because a person who is looking for some certain stable income, the debt part is there, and certainly we all understand the equity is more promising when it comes to growth of the fund. So it has both part, the warrant is equity part and the debt is already there in NCD. That is one thing. The second benefit is that it gives higher return than than regular debentures. So that because of the equity component, because of the warrant part, and not only that, normal debenture would have a little lower rate of interest than NCD. NCD would have little higher rate because there is a little risk involved with the equity part. So that is because of that, the more the risk, the more the return is expected, right? This is a very fundamental principle in finance. So that is why that because of this fundamental principle, the possibility of higher interest is there, a higher income is there in NCDs than normal debentures. The another point of benefit or the merit is the leverage opportunity. The companies can actually leverage. Leverage is the debt part, right? The leverage is using debt component. Because of the NCDs, companies can actually issue the leverage, the debt part, and then later on it can be converted into equity. Initially it can be leverage, and gradually after stability, after some time, it can be converted into equity. So, it is a good opportunity for a firm, for a business. There is a flexibility because the warrants could be exercised, could not be exercised. So, it gives flexibility to both investor and the company. And the last benefit is the capital appreciation with limited downside, because your capital may increase, go high if the market is doing well. Of course, the conditional, but in India especially, the markets are doing well from the last couple of years. So it gives a flexibility and a reason for your fund to grow. When it comes to demerits, there are a couple of them. Of course, nothing is, so every coin has two sides. Same is with NCDs. Number one is dilution risk is there. Number two is interest rate risk is there. Number three is liquidity risk is there. Number four, complexity, and number five, company specific risk is always there. So dilution risk means what? That ownership, because there is a warrant involved in the NCD. That warrant could be attached or could be stapled or could be independent, but nevertheless, if anybody decides to exercise the warrant or sell it in the market, then there is a possibility the ownership is diluted, because equity part, the warrant part gives the ownership right, the equity. So the ownership gets diluted, means decision making goes over many people, and anybody may take interest in the company, may buy many warrants and could interfere in the daily operations through the board, of course, becoming member of the board. The second demerit or limitation is interest rate risk. This is when this interest rate risk is for any kind of debentures, right? Company may fail to generate enough cash flows to pay the interest, because that component is there. So that risk is always there with the debt component. Liquidity risk, it may not be so easy for investor to sell them in the open market like any shares, etc., because that may not be, especially when the rate of interest goes up and your debentures are at less risk, less rate of interest, you are likely to face problem to sell those debentures in the market, those NCD in the market. And complexity, every investor cannot understand, people who are not financially, who are not literate in finance, right, who are who are not well educated when it comes to financial terms and finance markets, etc., they may face issue because of the complexity of the NCDs. And then, like any debenture, the company specific risk is always there. There are certain risks which are specific to companies. the company is operating in certain part of the geography, certain part of the world, certain, or dealing with particular no, product or seasonal products, they have a different type of risk. So any NCD issued by any company will be always exposed to the company specific risk, right. So this was all about NCDs. Now I want to talk about payable when able. So payable when able debt structure. Payable when able (PWA) is a loan structure that offers borrowers flexibility by only requiring repayment when they have financial ability to do so. PWA structures adapt to the borrower's income or financial circumstances, unlike conventional loans with fixed monthly payments. So, as the name suggests, PWA, payable when able, means you will be required to pay the debt you have taken when you are able to pay, when you have ability to pay, when you are able to generate funds or you have a repayment capacity. So, it means the payment is not fixed, you have been given flexibility. So, it's such a privilege, it means it is going to be an expensive product. So, it is a loan structure. So, this is payable. PWs are like a loan structure. We get loan for car, etc., that offers borrowers, who borrows, the flexibility, right, only requiring repayment when they have the ability to pay. So, it is not that you will be paying on demand, you will be paying on a particular date. For example, for housing loan we pay on a particular date, but you may not pay on a particular date. So, payable structures adopt borrowers' income or financial circumstances as per their need they are being paid. So, friends, this is the time to wind up. I will be carrying on the same discussion in the future session soon. So, we will be talking about payable when able structures in the next session. With more details, I will be discussing about this. This is the time to wind up. Thank you very much for being with me.